Hello traders, Gary Wagner here at just about 12:30 in Honolulu, 6:30 in New York. It is Thursday, 15th day of October 2020, and this is the daily report for gold and silver. We saw modest gains in both gold and silver, but that was in conjunction with real dollar strength. That shows me that the dollar and gold's inverse relationship is decoupling. And as the pandemic goes into a second wave, not only here, but in parts of Europe, we see both gold and the dollar being used as a safe haven asset, especially with the global weakness in U.S. equities. We'll talk about that in detail, but first, to the price board. Traders, both gold and silver, had a resilient recovery after trading to lows this morning in the case of gold, breaking back below 1900, trading to 1892.70 before recovering and actually closing at almost 1913. Currently, we've got December gold fixed at 1912.90. And although silver only had fractional gains, gaining about 3.5 cents, currently fixed at 24.43, the low today was 23.65. So just as in the case of gold, we saw tremendous selling pressure overseas last night, and then buying the dip mentality come into the market as traders moved into the New York session. GLD gained about 0.4% or 65 cents a share at 178.92. And lastly, SLV gained about 0.2% and is currently at 22.59 per share. And most impressive is the fact that the gains in silver and gold occurred concurrently with extreme dollar strength, 93.84.5. That is a net gain of over 0.5% on the day. And we have an delinking or uncoupling of the inverse relationship between gold and the dollar as we see both of them move higher. We'll focus on that when we pull up our charts. And traders, we are definitely seeing a shift in market sentiment in relationship to the inverse correlation that typically appears between gold and the US dollar. When we look at the initial reaction when COVID hit the United States as well as the world, this is back in March where I've just put these arrows up, the initial reaction was a strong higher spike in gold and a strong higher spike in the US dollar at the same time. However, around mid-March, we went back to a negative correlation where we saw the dollar really move down to these lows in September, and at the same time, we saw gold spike to its all-time record high, which occurred roughly the first week of August. Then we saw gold actually begin to trade lower, and that inverse correlation maintained because we saw the dollar gain some strength. But what we are seeing now is an interesting kind of shift in that recently we're seeing gold get stronger and the US dollar get stronger, just as we did at the onset of this pandemic. And because of that, I believe that this is a trend that could continue. In other words, gold and the dollar both moving higher simultaneously. Although gold prices have been really volatile with tremendous daily price swings, we can say that we have a rally that has now been in place really since, call it the last week of September, when we hit these lows here at about 1845. We've created a basic channel in which we have a series of higher lows and a series of higher highs. That maintains up to this day. Another very interesting aspect on a technical basis of recent activity is how gold has been following this 100-day moving average. You can see that in light blue. We've just added that to the chart almost to the letter. We also can see that the 50-day moving average continues to maintain a price point which is indicating resistance. We have converted the bar chart back into a candlestick chart, and I draw your attention to the last couple of days of trading in which we saw the market genuinely move higher up to the top of this channel. We had a star, almost a three-river evening star, but rather than confirming and indicating lower pricing, meaning breaking below the channel, these last 2 days have indicated that it has found major support at this particular price point, and all things being equal, will probably move higher. This makes me have a stronger conviction to enter the market. I am looking simply to position ourselves at the best possible price. That being said, I would definitely recommend buying any strong breakout. A breakout to me would occur at 1920. 1920, of course, is the former all-time record high that occurred in the middle of 2011. We can definitely see a historical indication on recent data that this has been a supportive price point, or buy the dip if the market came back down to these areas that we have on the bottom of the channel. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.